Hi guys, this is Nitin and I welcome you to my startup podcast channel Desire Audio where we share real stories with real learning. So, friends, in this week's podcast, I had a pleasure to invite my friend Tushar Kansal, who is the founder of Kansaltancy Ventures. Tushar is both a mentor as well as the investor, and in his corporate experience, Tushar has worked for Deloitte and several iconic brands in India. So, in this podcast, Tushar will holistically cover about term sheet, including its financial, legal, and other details that are typically incorporated in a term sheet. So, here we go. Hey Tushar, welcome to Desire Audio and thank you for talking to us.
It's my pleasure, Nitin. Glad to be here and talking to you today.
So let's start with the basics. What is a term sheet? When is it issued and by whom?
Term sheet is a document usually between 1 to 10 pages which captures the modality and structure of the investment which an investor would be making in a particular company, be it a startup or any other company. And this investment is made by the investor and the term sheet is also issued by the investor. It captures things like the amount he'll be investing, the valuation, and the instruments which he'll be using, the terms and conditions which come along with the investment, and also whether the term sheet in itself is a binding term sheet or a non-binding term sheet.
So what is the difference between the two?
Binding term sheet means that post the term sheet issue and the due diligence of the startup, there can be a change in the amount of investment basis the findings of the due diligence report, but the investment will have to be done. A non-binding term sheet basically means that at any point in time the investor has an option to back out, be it at the last day of the signing of the shareholders agreement.
Okay, so how do founders arrive at the valuation of their startup prior to fundraising as well as the equity stake they can offer to the investors?
So, when startup founders, they try and arrive at how would they value themselves? They can do it in 3-4 ways. One is by finding out comparable companies, similar to their startup, which are listed on the stock exchange. So the financial performance of that company and the market capitalization of that company, which is going on in the stock market, is this information is in the public domain. So you can get the ratios, get the multiples like EV to EBITDA or market cap to sales. So, and those multiples you can use on your own financial performance. The other way is you can find out transactions similar to your company which happened in the recent past, and again find out these multiples. So the financial performance of those companies are available on the MCA website. Third way is you can make a estimate of 5-year or 3-year projections of your company and find out the cash flows which will be available and bring them to a present value. And then there are other ways like the financial companies are valued at net asset value or price to book. So these are the ways in which a founder can arrive at mission. But all practical purposes, in case it's a revenue making startup, then in practical terms, on a ballpark basis, you can, if you are a 1 crore kind of turnover, you can look at asking for a valuation of around 15 to 20 crore. And in case you are a little bit less revenue company, you can look for a 12 crore kind of value.
And could you please explain with an example or two?
Yeah. So there is a company which is making a cloud-based EPBX solution, and the founder has invested around 1 to 2 crore rupees in making the technology. So this company had gone in the market to raise 6 crore rupees, and it had raised 3.5 crores at a valuation of around 20 crores. So by diluting around 16-17% of it. So similarly, there was a fintech company, it's a financial inclusion company, which was making very small turnover of 8 lakh. And because its model had very low commission, so it was valued at 12 crores in the first round.
Great. So what are the financial terms and conditions that a founder needs to be aware of in a term sheet?
The financial terms and conditions are like what amount the investor will put in and what percentage stake he will get against that amount. And then there are instruments like in case it's a simple equity which he's taking shares, but there are options available to the investor like preference shares, debentures and warrants. So in case, and those also preference shares and debentures are called quasi equity, quasi debt kind of structures. So they are also classified as either convertible, non-convertible. Then The other financial terms are like in if the company will issue employee stock option plans, ESOPs, to its employees. So as you know that startups are not able to pay market salaries in many conditions. So they also issue ESOPs. These are shares in the company, and these shares get vested in time frame of 1 year, 2 year, and 3 years. Then there are terms like anti-dilution, which means that in case the next round of the investment in the company happens at lower valuation than the current round, then the current investor will get additional shares to compensate him. Then some other unique terms like liquidation preference, which a lot of foreign investors are used to. So, in case you are issuing them preference shares plus normal equity, so they will say that on the preference share, you give me a double return. So, whenever the next time some liquidity event happens in the company and there is a chance to give an exit to the existing investor, so on his preference shares, he will say that I have a 2x return. So, on that part, he might ask for a double return. So those are called liquidation preferences. These are basically sweeteners for the investor to put in money.
Now, we have often heard about CCPS, which is compulsory convertible preference shares. What is that?
CCPS, so you are a company which is doing 1 crore turnover and you are asking for 30 crores valuation, and the investor is saying the valuation should be 10 crores. So what do you do? So in that case, you can keep the equity dilution contingent on the future financial performance of the company. So you can say that instead of normal equity shares, I'll issue you convertible preference shares, and these preference shares will get converted to equity at a future date on a set formula. So this formula can be like, I'll give you an example. We say that this preference share will get converted to equity at 10 times EBITDA after 1 year. So whatever EBITDA the company will do after 1 year, we'll assume the valuation at 10 times of that, and whatever money the investor has put in today, that can be divided by that new valuation, and shares and it can also be at discount to future valuation. Like whenever the next investment will happen in the company, whatever valuation will be there at that point in time, the current investor will receive some kind of a discount, like 20% discount to that valuation, because he's investing early and taking more risk.
And what are the typical legal terms as well as rights that investors incorporate in a term sheet?
So there are quite a few, but I'll try to run it in an easier fashion. So there are some conditions precedent which are mentioned in the term sheet, like the company would have completed all the legal, financial, tax, and business due diligence to the satisfaction of the investor. Then the investor will have the audited financial statements of the company, and all the compliances, corporate, government, regulatory, would be complete. The founders would have signed all the clauses mentioned in the term sheet in the shape of the final shareholders agreement. These are the precedent conditions. And then there are some subsequent conditions, like the company will file all the documents in relation to this investment as required under the prevailing regulations with the Reserve Bank of India, Registrar of Companies, or any statutory body. And the company will also amend its article of association to incorporate the terms of this shareholders agreement which is being signed. Then there are voting rights. How many seats the investor will have on the board of directors, how many voting rights he will have. Then he has information rights, that he will have a right to get the financial performance of the company every month, every quarter, so. Then there are some reserved matters. So, the investor says, I am coming into the company, but on certain decisions of the board of directors of the company, I have a right that my approval is a must till the time I issue, say, 5% of the share capital of the company. So this reserved matter can be like any merger or acquisition, any amendment to article of association, any new instruments which are issued to any new investor, and declaring of dividends or creation of any subsidiary, issuing of any employee stock option plan, or modification to the business plan, like companies pivot their business and adoption of financial statements, any sale of a huge asset of the company, or if the promoters are doing a related party transaction and transferring shares, or companies incurring any indebtedness, a huge loan which the company is taking, or entering into any joint venture, strategic alliance. So all these matters become a part of reserved matter. Then there are founder vesting, that the investor says that I'm investing because of the founder. If the founder leaves the company, then I have a right to take his shares and sell it along with my shares to a new investor.
Okay.
Then very important, Nitin, is exit clauses. Like the first exit clause is that the company will come out with an IPO. Second is the company will find a new investor and get an external valuation done and help sell the investor shares to the new investor. The third is that company will buy back the equity at a pre-agreed internal rate of return IRR from the investor. Then fourth one is that the founder will buy back the equity from the. Then there are some drag along, tag along, and right of first refusal clauses. Drag along means that if I am getting a buyer for say 51% equity and I hold only 25% equity in the company, so I have a right to drag along 26% of the founder's shares along with my share. And so this is a very important clause. Not all founders like this clause. Then there is a tag along clause. If the founder is selling his shares to a third party investor, I have a right to sell mine also. Then there is right of first refusal, that whenever the founder will sell his shares in the market, I have a first right to buy them. So these are like there are some non-compete and non-solicit clauses, that the founder will not open a new company and compete with this existing company. And non-solicit means that he will not solicit or hire any employees of this company till the time the investor is present.
Okay.
And also important, just last bit, is the reps and warranties, representations and warranties. So these are very important because they make representations like whatever info they have given to the investor is true, and so on. And there are standard indemnities also from the company and promoters to the investor, like they indemnify the investor and its directors, employees against any losses and damages suffered or incurred resulting from any breach of representations and warranties. So these are some of the very important parts of the machine.
Okay. So finally, what factors or aspects are considered extraordinary or beyond the acceptable industry norms?
So, the founders must know that any kind of equity is risk capital. So, if an investor is coming in and buying shares, then he's taking a risk. So, that risk is true to that investor. So, he can't force the founders to do a lot of things, which sometimes are actually deliberately put in the term sheet. So, one common practice is that the intellectual property of the company is hypothecated or kept as collateral with the investor. So, it's a defensive tactic, as in if the investor is not getting an exit from the company, then he has a right to sell the intellectual property and recover his money. So in many cases, because the investments are tech investments, so this kind of thing is actually, a lot of founders don't have a problem with this. But when you are talking about really exclusive technologies which have a potential of millions of dollars, then a lot of founders won't actually want to give this IP as a collateral. Then on the drag along clause, the valuation matters. If a new investor is looking for 51% equity and the investor says, I have a drag along clause and I can drag your shares. So, the founder should have a right to agree to the valuation at which his shares will be dragged along. Similarly, founder vesting, which means that if the founder is leaving the company, then his shares can be taken over by the investor, is something which is not very common. It is rare, and the founder should watch out for this. One very important fact is the number of seats held by the investor on the board. So suppose if the investor is taking 15% equity and asking for 2 seats in a board comprising of 4 people, of course, it is not justified. So it should be, commensurate with the equity holding. So an investor has 25% equity and taking 1 seat out of 4 seats, it's absolutely justified. And then the promoter lock-ins are there, which means that the promoter cannot sell his shares till the time the investor is present in the company. So those kind of lock-ins are also, sometimes they become too extreme. And last but not the least is DVRs, differential voting rights. So as you know, Mark Zuckerberg maintains total control of Facebook because his shares have additional voting rights and they are DVR shares. So these kind of shares, if investor is asking from the founder, then he is actually influencing more control than his proportion of the shares, and which the founder should watch out for. But matter of fact, like the Tatas hold less than 50% equity in a lot of their companies in the conglomerate, but they maintain control using DVR. So in case the founder wants to maintain control using DVRs, then she should definitely do that. But by and large, these are the clauses which I think the founder should watch out. Else, instead of venture capital, it becomes sort of vulture capital.
So with this, we have reached at the end of this podcast. Tushar, thank you so much for being on Desire Audio and sharing some great insights with us.
My pleasure. It's absolutely my pleasure, Nitin, because your podcasts are so insightful. I hear them each time. So thank you for calling me.
Are you a founder of an early stage startup and looking to raise funding? Get your startup investor ready before even you start pitching to your prospective investors. For know-how, please visit www.jazaro.in. That is www.jasaro.in.
Lastly, I want to thank all the listeners who took their valuable time to listen to this podcast. Keep rocking, be safe, and don't forget to share.